You can do everything right, score in the top percentiles, earn the advanced degree, and secure a six-figure salary, and still find yourself drowning in stress with almost zero actual wealth to your name. We are taught a very specific formula for success. Get a higher education, land a solid job, and financial security will naturally follow. But the math of that traditional equation is broken. You trade your time for a salary, flowing directly into living expenses, looping endlessly. This is the rat race. Working harder won't break the loop. As your salary node inflates, the bills node immediately expands to match it, scaling up exhaustion. The mental framework dictating where money flows, more than the raw size of a paycheck, is what determines long-term security. To understand how to rewire this system, we have to throw out traditional accounting jargon. The only metric that matters is literal cash flow. In this framework, an asset has a strict, specific definition. It is any mechanism, like a small business, a rental property, or dividend-paying stock, that physically pushes money into your pocket without requiring your daily physical labor. A liability is the exact opposite. It is any possession or obligation that consistently pulls money out of your pocket. The middle class often stalls because they purchase liabilities while operating under the impression that they are accumulating assets. Financed vehicles and expensive technology upgrades act as continuous red arrows, actively draining your central bank account reservoir down to zero. Add a primary mortgage, and an even larger red arrow siphons your cash flow directly toward the bank for 30 years. Long-term financial ruin is actively engineered when individuals systematically feed their income into structures explicitly designed to drain it. So what happens the exact moment a wealth builder earns a dollar? Their cash flows in a completely different direction. Rather than buying consumer goods, wealth builders divert initial dollars into income-generating vehicles, pushing new green lines back to the start. Then, compound mechanics take over, returns generating subsequent returns. The business node multiplies the green lines, creating a self-sustaining cycle without physical labor. To protect this expanding pipeline from being depleted, wealth builders use a powerful mechanical advantage, the corporate tax shield. A standard employee's flow: earn, pay taxes immediately, spend what remains. A wealth builder's flow: earn, use a corporation to invest and spend first. The investment node absorbs the massive majority of pre-tax capital, leaving only a tiny trickle for the final tax node. This closed-loop engineering system legally repels taxes and multiplies capital through systematic reinvestment. If the mechanics are this straightforward, why aren't they universally adopted? While standard education requires years of math and science, it almost never offers courses on tax law or asset management. This specific curriculum focus prepares students to be effective employees who understand how to earn a salary, but not how to build the systems that pay it. Building an asset requires a different kind of fuel. It requires mastering real-world skills like sales, business logic, and clear communication, rather than collecting more academic degrees. The final barrier is psychological. The fear of failure and the addictive comfort of a guaranteed paycheck keeps people gripping a fraying safety net. Let's look at the exact mathematical threshold for breaking free. True financial freedom occurs the precise moment this rising green bar, the passive income generated by your assets, overtakes and eclipses the red line of your monthly living expenses. Relying solely on a salary guarantees a lifetime of renting out your time. Building mechanical systems where your money works for you guarantees your freedom.